Hold up. Drop the charts. Because today the narrative we've been feeding ourselves about this rigged game for 15 years just imploded. For a decade, we thought we were battling the bullion banks. We swore they were trapped in naked shorts, tamping price to survive. When ag finally mooned, ripping past levels nobody predicted, we figured we'd won. We thought this squeeze was their end. It wasn't, though. This wasn't a short squeeze. It was the rug pull reveal. The sketchiest moment in stacking isn't a crash. It's realizing your whole thesis was a lie. New data just completely rewrote the history of the silver market. JPM wasn't caught off guard by this rip. They didn't panic. They didn't lose the wheel. They were prepped. While stackers screamed manipulation and paper shorts, the whale was executing a far slicker strategy. They were stacking physical bars, hard, quietly, like pros, for years on end. Not SLV paper, not IOUs, actual shiny. And now the size of that massive stack is public info. Roughly 750 million troy ounces of physical metal. That figure changes the game. It means the biggest bank has zero reason to tamp the price now. The whale we thought was the enemy is actually positioned to profit when spot price explodes. Ask yourself, if you held that much scarce hard asset, would you fight the rip or would you let it fly to the moon? You got it. This is where the old story dies. The bank we thought we were squeezing isn't blocking us anymore. They're moving the same way now, just for totally different reasons. When the biggest financial whale on earth decides an asset gets repriced, the market doesn't argue back. It just gets in line. To see how this bear trap was set and why the next leg up is wilder than anything we've seen, we gotta rewind to the start. Right back to the crime scene. If this shifted your view, smash subscribe and comment 1 if you're ready to roll. To see the trap, rewind to 2008. Ignore the headlines and the panic. Look at the balance sheets. When the system broke, one bank tanked first. Most blame bad mortgages. But almost nobody mentions the massive short position on its books, hundreds of millions of paper ounces completely detached from physical reality. That short was a control tool, not an accident. It capped rallies and kept ag cheap and ignored. But in early 2008, spot rose anyway. Margin calls hit. Liquidity dried up. The weapon backfired. When the bailout happened, the buyer inherited that short. The market assumed they'd cover it immediately. That assumption was dead wrong. Because they didn't close the short. They kept it open. Holding the big short isn't just risk management. It's price control. You decide when rallies die and fear spikes. And every time they slammed the price with paper, something huge happened in the background. Physical silver moved hands. Miners sold low. Weak hands folded. Supply popped up and vanished. The same whale crushing the price was waiting below, scooping up real metal ounce by ounce. Paper shorts funded real stacks. This loop ran for years. Rallies died, sentiment tanked, ag got boring. While the herd stared at charts and raged, the vaults were quietly filling up. By the time the herd smelled a rat, the physical market was already drained dry. That's the core con. The short wasn't the problem, it was the tool. Once you see that the endgame is inevitable, nobody builds that much control without a final play. And that big move is incoming. Once you get the short was a tool, the next phase is clear. Control wasn't the goal, total ownership was. For years, the market thought ag was dead. No mojo, every rally failed, breakouts flopped. Analysts called it a barbarous relic, but that boredom wasn't an accident, it was engineered. Boring markets are easiest to drain. Every tamp killed confidence, retail bailed, institutions left, miners starved of cash, dumped production at any price to survive. In that mess, physical silver hit the market, but only for a second. Every dip flushed out supply. Every dip met the exact same buyer. This wasn't FOMO. It was industrial hoarding. Vaults expanded quietly. Inventory left the COMEX for private hands. The metal didn't vanish overnight, it disappeared slowly so no alarms tripped on. That was the genius of the play. Instead of chasing green candles, they forced red ones. They didn't compete. They created despair. And despair is the cheapest source of supply there is. Year after year it held. We saw manipulation. We missed the conversion paper pressure turning into physical ownership. Paper losses offset by real assets. What looked like suppression was actually harvesting. By the time solar and EV demand ramped up, the cheap metal was gone. The float had been shrinking while nobody was keeping score. This is why it feels different. Accumulation phases don't announce themselves. They end abruptly. And when they do, price action changes forever. The second the stacking stops, suppression becomes impossible. And when the whale manipulating the ceiling steps aside, the spot price doesn't just drift higher, it snaps hard. That violent snap is exactly what you are seeing now. And it signals a move far more dangerous than a mere rally. It proves the smart money is finished stacking now and ready to let the spot price do all the work. Stack accumulation always ends the same way, quietly, then suddenly, all at once. For years, the bank manipulation holding silver down was constant. Every rally met resistance. Every breakout was capped. The ceiling never moved, until suddenly it did. That break was not an accident, it was a firm decision. Sometime in late 2025, the manipulator left the control room. The pressure that defined the market for more than a decade was lifted. The whale that once spent billions suppressing spot price no longer had a reason to do so, because the physical accumulation was complete. Once you stack enough of a hard asset, the incentive structure flips. Spot price is no longer something to fear. It becomes the weapon. And the moment that shift happens, market behavior changes instantly. That is why silver did not grind higher. It launched hard. There was no prolonged battle at old resistance levels, no extended consolidation. Spot moved vertically because the big naked shorter vanished. The brake pedal was released, and gravity took over in reverse. This is where most paper traders get confused. They look for a catalyst. They look for news. They assume a squeeze. But this was not panic buying. It was absence. The price ceiling was not broken. It was removed. Every dollar higher now benefits the largest stacker in the market. Every pullback becomes optional. There is no longer a structural force committed to pushing spot down. Volatility may remain, but the direction is changed. And that structural change is permanent. Markets do not forget who controls supply. Once spot starts moving in an environment where the physical float is thin and the largest whale is aligned with higher prices, the path of least resistance points one way. Straight up. This is why the old playbook stopped working. This is why paper selling pressure looks weak. This is why dips feel shallow and temporary. The regime has shifted from suppression to repricing. But the switch was not flipped blindly. It was well timed. Because no one releases control without a reason. And the reason for this move was not speculation, it was necessity. Something much bigger was coming, something the market could not ignore. And to understand why the timing mattered, you have to look beyond spot price and into supply itself. That is exactly where the real leverage begins. Paper price can be argued, supply cannot. Silver is not scarce because of sentiment. It is scarce because geology sets limits that paper finance cannot override. Every year, the entire planet produces a finite amount of silver, and most of it is not mined on purpose. It is a byproduct pulled from the ground while chasing other metals. That makes supply slow, rigid, and brutally unforgiving. Physical demand, meanwhile, does not wait. Electrification, solar panels, electronics, medical equipment, defense systems. Silver sits at the center of modern civilization. Unlike investment demand, industrial demand does not care about spot price. It cares about continuity. Factories do not shut down because silver gets expensive. They shut down when silver is not available at any price. That single distinction changes everything. For years, rigged paper markets created the illusion of abundance. Futures contracts multiplied supply that did not exist. Prices stayed low and industries built their cost models on that fiction. Just-in-time delivery replaced stockpiles. Inventory became a liability. Efficiency became doctrine. And now that paper illusion is cracking. When physical availability tightens, spot price does not adjust smoothly. It gaps. Because the buyers stepping in are not traders chasing upside. They are procurement managers with contracts, penalties, and production lines on the line. They buy because failure is not an option and delays are not acceptable. This is where control over real inventory becomes power. When supply is thin and demand is mandatory, the holder of physical metal dictates terms not by force but by restraint. By choosing when to sell, how much to sell, or whether to actually sell at all. That is the reality the market is waking up to, and once real necessity enters the equation, price targets stop being opinions. They become firm requirements. When supply tightens, markets instinctively search for relief. They look for a stabilizer, someone willing to release inventory, absorb volatility, and restore order. In oil, that role belongs to nations. In agriculture, it belongs to governments. In shiny silver, there is only one holder large enough to matter. And that fact changes the entire rigged game. When a single entity controls a disproportionate share of available supply, it becomes the buyer of last resort on the way down and the seller of last resort on the way up. That power does not need coordination announcements or headlines. It operates quietly through pure patience and absence. If spot dips, there is no obligation to sell. If price rises, there is no urgency to act. Time becomes an ally, not a risk. Every day the structural deficit persists, the leverage embedded in physical inventory increases daily. This is why volatility no longer signals weakness. Pullbacks do not mean distribution, they signal discipline. The absence of forced selling is the tell. No panic, no desperation, just controlled and quiet restraint. Markets are conditioned to expect central banks to intervene when stress appears. This is the opposite dynamic. This is a private holder allowing pressure to build because pressure increases value. The more strain placed on the fiat system, the more essential each ounce becomes. And here is the decisive shift when industrial users enter the market. Selling stops being optional. It becomes survival-driven. Buyers do not negotiate prices, they accept them. True price discovery accelerates not from speculation, but from the fear of interruption. That is how repricing happens in the real world, not through headlines, but through urgent purchase orders and empty vaults and inventories. And once that process begins, it simply does not reverse, because relief can only come from supply, and that supply is controlled. No market is ever cornered by accident. It happens when pressure arrives from more than one direction at the same time, slowly, quietly, and then suddenly all at once. On one side, physical supply tightens quietly. Export flows dry up, refining capacity shrinks down, logistics turn political. On the other side, real metal moves into fewer, distinct, strong hands. Each force alone is tough. Together, they remove every single possible escape route. We call this the big squeeze. When external flow contracts while internal stacks are deliberately withheld, buyers lose all optionality. They can't source metal abroad and they can't coax it out domestically. Paper price no longer balances supply and demand effectively. It becomes a toll payable only by those who arrive early or can afford true desperation. In this market, timing matters more than intention. Whoever moves first doesn't win. Whoever is prepared does. And in silver, preparation means physical possession, not paper contracts, not promises, real metal. The genius of this squeeze play isn't aggression. It is patience. One side applies pressure by restricting flow. The other applies pressure by refusing relief. This trap doesn't need constant force. It tightens automatically as valid stockpiles drain and deadlines approach. That is why the reaction feels sudden. The system absorbs stress quietly until it can't. Then behavior changes overnight. Orders stack up, physical premiums detach from a spot, availability disappears without warning. This is the phase where spot price stops reflecting value and starts reflecting urgency, where hesitation becomes risk, where procurement becomes panic. And in that moment, every remaining physical ounce becomes leverage. Because in a real squeeze, survival doesn't belong to the loudest buyer or the fastest trader. It belongs to the entity already holding the shiny metal. Every market corner creates winners and victims, and the most common mistake investors make is assuming the victims are small players. They certainly aren't. The true victims of this squeeze are the largest, most powerful industrial consumers in the world. The companies that built trillion-dollar empires on the assumption that raw materials would always be cheap, abundant, and fully available on demand. For decades, technology and manufacturing were subsidized by artificially low commodity prices. Hardware was treated as disposable. Supply chains were optimized for efficiency, not resilience. Physical inventory was eliminated. Risk was outsourced to the market. That fragile system worked only because someone else absorbed the pressure. Now that pressure has simply nowhere to go. When silver availability tightens, these companies don't have flexibility. They don't hedge years in advance. They don't stockpile critical inputs. They rely on just-in-time delivery to keep margins high and balance sheets totally clean. That model collapses instantly when physical supply stops moving. Production schedules don't care about narratives. Contracts don't care about ideology. A factory without silver doesn't slow down, it stops. And when it stops, the losses compound by the very hour. This is why the coming demand won't be polite. It won't be gradual. It will be urgent, forced, and price insensitive. Procurement managers won't be negotiating discounts. They'll be securing sheer survival. And here's the cruel irony. The very system that suppressed prices for years encouraged this vulnerability. Cheap paper silver taught industry to be careless. Stability bred dependency. Now that market stability is gone. This is where the transfer begins, not from retail to institutions, but from industry to inventory holders. From balance sheets built on efficiency to vaults built on real possession. The winners won't be the loudest voices in the paper market. They'll be the ones who prepared when preparation looked wholly unnecessary. At this point, most people think the story is finished. Supply is tight. Inventory is concentrated. Industry is trapped. It is the end of analysis. That assumption misses the single most important layer of all. Because silver isn't just an industrial metal, it is a monetary mirror. And what it's reflecting now isn't just scarcity, it's real currency stress. When a critical commodity reprices sharply, it forces a question no central bank wants asked. What is the unit of account actually worth? Rising silver doesn't just signal demand, it exposes dilution. It reveals how much paper has been created relative to real things that cannot be printed. This is where the trade stops being about metal and starts being about real money. As prices rise, policymakers face a dilemma. Tight supply drives inflation signals higher. Inflation pressures interest rates. Higher rates threaten debt markets. And when debt markets wobble, intervention follows. Liquidity returns. Balance sheets expand. The fiat currency absorbs the shock. Silver responds to it immediately. This creates a feedback loop that is hard to interrupt. Scarcity pushes price up. Price signals inflation. Inflation triggers easing. Easing weakens currency. A weaker currency pushes silver higher yet again. This is not speculation. It is basic arithmetic. And the holders of physical metal understand this better than anyone. They aren't just holding inventory. They're holding insurance against the very system pricing that inventory. Every ounce represents optionality outside the fiat currency framework. That's why selling becomes less attractive as price rises. You're not just giving up upside. You're trading something finite for something easily expandable. This is the hidden force underneath the entire move. Supply pressure lights the match. Monetary response pours the fuel on it. And once that cycle begins, it doesn't end with a neat top or a tidy market correction. It ends when the public confidence breaks. And that brings us to the final chapter, because knowing the structure is useless unless you know how to navigate it all. This is where everything truly converges. What began as a story about suppression became a story about accumulation. What looked like manipulation revealed itself as preparation. And what now appears to be a price rally is in reality a structural reset driven by scarcity, necessity, and total monetary decay. The lesson is simple, but uncomfortable markets don't reward outrage. They reward early positioning. For years, silver holders were mocked for owning something boring, volatile, suppressed. But boredom was the price of admission. It was the tax paid to stay positioned while the real game unfolded quietly in the very background. Now the game has finally changed. When mints run dry, silver stockpiles vanish and fiat currency collapses. Spot price stops tracking sentiment. It tracks leverage, and that power belongs to the stackers holding the real physical metal the world needs now. This is the true squeeze. This does not mean zero volatility. Expect tamps, sharp pullbacks, media fear, attempts to shake out weak hands. That is how the bullion banks grab the remaining supply. The mistake is confusing e-paper games with the true direction. The trend is driven by fundamentals, not feelings. So the strategy is not about chasing peaks or timing the top. It is knowing the power of your stack. You do not sell true scarcity for fiat debt notes just because the spot price jumped. You swap it deliberately for other hard assets when the transaction secures your wealth in the physical world today. Stacking silver is not just a trade now. It is a hedge against collapse. It is insurance against the reset. It is a claim on physical truth in a financial system built on debt. And that is exactly why this squeeze matters. You are not late. You are early to the collapse. Most normies only see the spot price. A few apes will understand the value. If this intel helped you see the rigged game clearly, subscribe to stay ahead of the coming reset, smash the like button if this view added value, and share it with someone who still thinks this movement is merely wild speculation. Most importantly, comment below on what you are stacking next, because this silver squeeze story does not end here. It has just entered the phase where the physical shortage cannot be ignored.